The most important risks in portfolio management. I should tell you that our focus, I think I mentioned this, but I want to just be really clear. Our focus in 2024 with our live events is going to be all about portfolio management and building the complete portfolio. We have never done that before on the road. And starting next week, we will announce our the different cities we'll be going to in 2024 and the different events. And the primary event is going to be on building kind of the perfect portfolio, or building, a complete portfolio. And very excited about this show with 6 different speakers and lots of things that we've never done before. So should be really good. And I think we're going to be 11 cities next year. So hopefully we'll get to someplace by you, and you can come out wherever you live. There'll be Super Bowl cities, but hopefully. The most important risks in portfolio management. Let's see what we got here. Despite the challenges at the beginning of the year, the stock market has seen impressive growth across all 4 major indices. The NASDAQ in particular has achieved an exceptional return of over 53%, reaching a level almost identical to that of 2009. I think that's wrong. Did we reach some level? No, that's wrong. I'm sorry. I take it back. They're talking about the percentage. That's correct.
Percentage, not the price.
Yeah, I got it. And we were up about, I think we were up 55% in 2009. So they're right. I'm sorry, take it back. My apologies to the research team. So sorry. S&P's up almost 24%, and much of that has come in the last 2 months. Like I said, the S&Ps are up, what did we say yesterday? 13. They've had 7 down days since November 1st, and they're up, 12 out of the last 13 days. NASDAQ up 53, almost 54%, the Russell up 16%, and the Dow up 12%. That's why I'm selling NASDAQ and staying short NASDAQ next year. It's all over, Johnny.
It's all over, Johnny.
Let's go to the next slide.
Crying.
As we enjoy the stock market's recovery and anticipate lower interest rates in the future, or at least the market does, it is crucial to understand how to safeguard our profits by managing the following important portfolio risks. We're going to talk today about managing directional risk, correlation risk, buying power reduction, and capital risk, which is really another word for capital efficiency, and tail risk. This is just a little tiny intro and a little tiny just taste of some of the stuff we're going to be doing next year. Let's go to the next slide. So the first thing is directional risk. Each position carries its own directional risk, which is quantified by delta. A lower delta indicates a lower level of directional risk. That is kind of master of the obvious, if you can reduce your delta, you'll reduce your risk, period. There's nothing else to it. There's no magic to it. Let's go to the next slide. The most effective way to measure a portfolio's directional risk is by using the beta-weighted delta. These are all just screenshots of the platform. If our portfolio is exposed to too many long or short deltas, we may need to make adjustments to the current market conditions and to our directional assumptions. One of the things we do a little different at Tasty than any other platform and any other anybody else that talks about markets is we beta weight everything to the SPY, which means we convert all our positions into SPY deltas so that we can manage our overall positions with a single number. We're the only platform in the world that does that as a default.
Yep.
Let's go to the next slide. Simplification. Correlation risk. If 2 assets are highly correlated, a decrease in one position will likely lead to a decrease in the other position. This is why balancing a portfolio with low or non-correlated asset combinations, such as SPY and TLT, because those two are offsetting, is highly recommended. And those two don't have a correlation that's kind of wrapped around zero. Is this an easy thing to do? No, not at all. Is it something that we've become fairly adept at doing? Yeah. Yeah, we've talked about it enough. We've become pretty good at it. Let's go to the next slide. Ideally, the correlation between two assets should fall between the range of negative 0.5 and positive 0.5, which is considered to be low. Additionally, diversifying option strategies can be another effective way to mitigate risk. I covered a lot of this stuff in the digital asset collectible that we did, and we've covered a lot of this stuff on the show for years now. But from a negative 1/2 to a positive 1/2, if you can hang out in that range, you're pretty good as far as your correlation risk.
Mm-hmm. Whoa, what do we got here?
What do you mean?
A lot of green bars, a lot of green.
So the correlation between two assets, which I just said, should be between negative 0.5 and positive 0.5. And what you see right here is we're showing a 12-month correlation of a bunch of different underlyings. So there's utilities, there's electric cars, there's crude oil, there's bonds, there's FXE is the U.S. dollar versus the euro. There's gold, S&Ps, and NASDAQ. And when you look on this chart, the reason we put it up here is you can see how low the correlation is on everything except for the indices. That's a nice thing.
Yes, sir.
Let's go to the next slide. So this is the challenging one, is buying power reduction and capital risk. Optimizing capital allocation and increasing buying power usage can lead to higher returns under favorable conditions, but also increases the risk of greater losses in a market downturn. The ideal range for capital allocation and options portfolios between 25 and 50%, with a max of 75%. You're always going to be skewed higher in higher volatility and with smaller accounts. And you're going to be skewed lower in lower volatility with larger accounts. Mm-hmm. Next slide, please. Also, the buying power reduction of existing positions may increase when they are under pressure. So if a portfolio is over-allocated during unfavorable market conditions, traders may find it challenging to maintain their desired positions, making it difficult to defend against losses. That really is more a futures thing, a futures and futures options thing, than it is a regular listed option thing. Listed options, the buying power reduction really doesn't change, but in the futures market, it changes a lot more dramatically. And futures options. Cheap to start with, but more expensive as something moves. Let's go to the next slide. For example, if we allocated 25% of the capital we had into the SPYs and we sold 30 Delta puts, the account would have been able to weather the 2008 stock market crash with 50% of its value remaining. However, this portfolio may have depleted its buying power, and that is a good example. Now, there's not a lot of 2008 kind of meltdowns, but this is, and we've talked about this before, this is the simplest, most conservative case. Simplest, most conservative. We don't trade this way. We are much more aggressive, but this is the simplest, most conservative case. Let's go to the next slide. So let's talk tail risk. Multiple standard deviation movements can happen and significantly impact a portfolio. On average, there's a 5% chance of a move twice as large as expected. And these surprises are usually on the downside. But with equities, in these three indexes are usually on the downside. But with equities, it's usually on the upside. So the mean rate of outliers, 5, 4, and 5, and the frequency of back-to-back outliers, very small. It's a fraction of that, 2.7, 3.4, and 2.5. That's like super ugly.
Yes.
Let's go next slide. So to reduce the likelihood of tail risk, traders can A, reduce the size of their positions, B, utilize risk-defined strategies rather than undefined ones, and C, consider longer duration positions such as 60 days or longer, as the market corrections typically do not last longer than 2 months. Although there's no way to, lock that down, the reality is, if you ever want to reduce risk, go out to a slightly longer period of time. And if you're ever nervous about the trade, just do a defined risk trade, as opposed to a naked strangle or something like that.
Or reduce your size, or do both, right?
What Tony and I do is we always reduce size. Whenever we're nervous about something, we reduce size. Simplest way to get away from everything. The size kills. So if you can reduce size, you're always around.
Very good. Let's take a quick 90-second break and come back. We got more Tasty Live after this. The opening bell next, Sadnov. We'll be back in 90 seconds.